Good morning. Good to see so many of you here. Saturday morning is a little bit early, I think, for younger people. I'm very happy to see so many people interested in investing, interested in the markets. So with me here, the panelists, just quickly get right into it. A set of C-suite leaders. We have from my far end here, Clarence Chan. Clarence is Singapore CEO and Head of Investment Oversight and Client Solutions APAC for BNY Investments. Then we have Jin Ye. Chong Jin Ye is Group CIO of UOB Asset Management. Here, CIO is Chief Investment Officer, not Chief Information Officer. Sometimes people get confused in the day of fintech. Vincent Chan, Deputy CIO, Fullerton Fund Management, and Wang Yi, CIO of CSOP Asset Management. Yeah, and I'm Chuen Ting, CEO and CIO of Money Hour. So let's dive right into it as we need to reimagine the future of finance. And let's start from the macro, the economies, and also what's happening in the world and the market. So about 3 months ago, we had that Rose Garden Liberation Day, that amazing tariff the table, right, that President Donald Trump laid out, and then the markets went wild. And not so long after, we had bond yields spike. There was a lot of jitteriness in the market, and then there was a rollback of that. Now, in the last 3 months, despite all that and the escalation of war with Iran and Israel and the dollar weakness and all that, we saw the S&P 500 actually hit a record high, although it came down slightly over the last week. So given all this, there's a lot of talk. Has the world changed in such a way that investments need to change? So perhaps I would go to Junior first, right? What do you think, in terms of expected returns, in terms of asset classes we need to invest in, what has happened changed things fundamentally this time for us?
Okay, hello. Well, I suppose, I think for those who have been investing for the last 30 plus years, there's a few regime change that we have actually come across. One is in the late 90s when we had the Asian financial crisis. And then 2008, we have the global financial crisis. And not too long after the COVID, we are living in a new regime where some of us call it higher for longer. Inflation will be sticky, interest rate will remain high, and then you have a lot of government that is more nationalistic, protecting their own country, protecting their own industries. So over the next 5 to 7 years, I think we are in this new regime where maybe over the long term, a de-dollarization trend. A de-dollarization trend means US dollar will not be the only safe haven currency in the world. A deglobalization trend, I think we all know of all this tariff. Every country is trying to protect themselves, try to negotiate their way with Trump administration. So what it means is that going forward for your portfolio constructions, you need to diversify. You need to diversify over different asset classes, not just equity, not just fixed income, or maybe some of us may talk about some of the alternative asset classes, including gold. And you need to diversify your risk. Risk in the sense that because if US dollar is not the only safe haven currency in the world, you may want to build a basket of currencies, including German bonds, JGB from Japan, or even Sing dollar. Sing dollar is a very safe currency in this part of the world, whether it's in treasury bill or in some of the low-risk fixed income portfolio or funds. So I think over the next 5 to 7 years, we need to be very mindful of this de-dollarization trend. There's going to be a shifting of economic power and deglobalization trend where there's going to be redistribution of economic influences in the world. Thanks.
Thanks, Junyuan. Perhaps I could ask Vincent to talk a little bit more about how this de-dollarization might happen. After all, we're talking about US dollars still being about high 50% of global reserves. The second one is like euro, and is there really an alternative? Or how quickly will this happen? And what impact does it have on asset allocation from your point of view?
Thanks, Chin Ting. So I will probably offer three opinions. One for investors to consider thinking longer term, and de-dollarization is part of the trend in terms of thinking longer term. Secondly, I'll just outline very briefly the implication of de-dollarization and what it means for the portfolio. Thirdly, I would have a short comment about the AI-enabling platform that gives you lots of information. While it may give you a lot of power, flexibility, trading, but please do not forget, if you want to invest for long term, it's better to have a roadmap in front of you. So going back to the first point, the AI-empowered phenomenon, giving you research, giving you ability to trade many instruments, to me, it's like a GPS. It allows you in instantaneous view of how you're going to get from point A to point B, knowing where the roads are congested and taking alternative routes. But the more important thing is, at the end of the journey, where are you going to? How are you going to accumulate wealth? And for that, I need to touch on the underlying creation of wealth and how you can include that in your portfolio. So there are four very typical ways wealth are generated. One is growth. Companies growing, they generate wealth, and equity is the instrument for that. The other one, which is a very popular asset class to own, is bonds. Bonds create wealth through what we call term premium. Put more simply, is time. You put money in a longer dated time deposit, you earn and you are paid a higher yield. So you're creating wealth by foregoing and not consuming, but you are actually letting the passage of time to accumulate wealth for you. So bonds play that element. The third one is seldom heard in many forums, particularly among the younger investors. I think the other investors, institutional investors, they have exposure to alternatives. Alternatives is a way to unlock wealth in illiquid assets, properties, private equity. Investors need to be patient and need to have exposure in that. And that's called the illiquid wealth generation. The fourth one is very common, easily to understand, is leverage. So leverage, when used properly, would have the wealth creation element. So in short, if you have this as a backdrop, the end of the journey that you want to do is to get wealth accumulation, and you need exposure in each of these four areas. So how does de-dollarization impact this? I think the dollar has been the anchor currency, the world reserve currency. It impacts in the way financial assets are priced and is denominated. Let me give you a very good, simple examples. Everything needs a benchmark to price everything else. So the US Treasury provides the risk-free assets. It gives you the basic risk-free, not taking a lot of risk, guaranteed return, guaranteed by the US government. Now, if de-dollarization happens, your benchmark yield will change and it will affect the way all the other asset classes are being priced. In layman terms, if my price of coffee, if I take from the hawker center, goes up from $1 to $3, you will know what will happen to the rest of the food that you're taking, because it's a benchmark. Everything is relative. Coming back to de-dollarization, it is important because the US dollar affects the monetary policy, basically the interest rates in the rest of the world. If the Fed is cutting interest rates and if investors are losing confidence in the dollar, it will have a lot of implication on the other currencies around the world. In Singapore, I think you can feel it already. With the dollar coming down, I think it lost about 8% against Sing dollar in the first half of this year, fell from 137 now to 128. It will suppress interest rates in all these countries because the countries trading in the US would be uncompetitive when the currency rises against a falling dollar. So the central banks will try to reduce the pace of appreciation by pressing down interest rates in their domestic currency. This will have significant implication on liquidity flowing into the other asset classes. So that's why you see a huge jump in stock market prices in the alternatives that I talk about, property and so on. So de-dollarization affects many financial assets through the way they decide what is the benchmark yield, the government risk-free rate, and how it spills over to the other countries. Then the last point, of course, what is the alternative to the dollar? I think the dollar has, for the last 50 years, been accepted as the world reserve currency, and a lot of people focus mainly on how to generate return. What mix should I have? A very popular mix is 60% equity, 40% bonds. They do not worry about the dollar's stability. If this is in question, then not only will the dollar question mark be on itself, it will also bring about a question mark on government bonds. I think you may already know that the AAA status of the US Treasury has already recently been downgraded, lost. So what will this do to investors? Investors wanting to hold AAA will run to the remaining countries that offer AAA rating. Singapore is one of them. But the more important question is, has de-dollarization, has world reserve currency lost its appeal in the past? And what happened to the asset classes? This is a very important question because it seldom happens. It happens whenever there's a change in leadership. I think about 200-300 years ago, the Dutch guilder lost it to the pound sterling. In our lifetime, we probably not in our lifetime, but we've seen how the pound sterling lost its status to the US dollar, and now the US dollar is being challenged. What people may not know is during the transition, what happened to the financial markets? Typically, interest rates will be bonds, government bonds may not be that reliable. And this is where, when we talk about alternatives, gold becomes an interesting proposition. Because when the dollar loses its value, investors question whether the US government can pay and honor its debt. So interest rates may be required to pay a higher premium, higher level of interest rates to retain the investors. So this is where you have uncertainty of the dollar spilling over to the bonds, and your traditional 60-40 may not work as well. Many investors have started switching into gold. Then maybe a final point in the conscious of time. As I mentioned, the AI effect is giving a lot of people power on their apps, on their phone to trade. But I would encourage people to think about risk management. Maybe I'll pass the time back.
Yeah, thanks, Vincent. So we can come back to AI later if we have time and if there are questions from the audience. On gold, I wanted to pick you up on that, the alternative to bonds, and which are obviously anchored on US Treasuries. For retail investors, how much do you think they should allocate to bonds, to gold? Because after all, gold is a non-yielding asset over the long term. You know, sometimes it goes up when the markets come down, sometimes it doesn't. Yeah, so it's a drag on the portfolio if you say you have 40% in gold. I can't imagine that we would advise that. What do you think?
Typically, history can offer some idea. So when you have a de-dollarization, the first question you ask is how long, how quickly it happens. It will not happen in a very short period of time. For a major currency to lose its world sovereign currency status, it would take a number of years. So having an allocation must take that into account. And when you have a changeover, typically the currency itself would lose probably more than 40%. So, and what will happen to gold in that space? Gold typically, if we go back to history and look at a change in world status currency, gold would go up 3 times or even 4 times. So it's a very big move we're talking about, so you don't need to have a lot of exposure to gold. For 60-40 equity bond portfolio with an annual volatility, annual risk of about 10%, what is recommended is a small allocation, about 5%, to recognize that it doesn't earn yield, and this de-dollarization may take a few years to play out. So in the meantime, it's a portfolio drag. But when it happens, it's too late for you to buy insurance, and having this 5% exposure at least can give you the uplift if the risk event happens.
Thank you, Vincent. I think overall what we are seeing playing out sort of supports this idea of one of the fundamentals of finance, which is diversification. There needs to be global diversification and not to be thinking really only about trading and short-term moves. Yeah. So let's move on to a theme of different ways of investing. So even as we meet these macro trends, over the last maybe 10, 20 years, there are other investor and product trends as well. So passive investing has been on the uptrend. How many of you in the audience have heard of passive investing? Could you just give me a wave? Yeah. So perhaps I could ask Wang Yi, maybe just quickly explain what is passive investing versus what, normal investing, active investing? Perhaps you could tell us.
Passive versus active then. So just quickly, passive investment is traditionally considered as an index tracking fund. Now we're familiar with all the index tracking ETFs in the world. NASDAQ, S&P, Hang Seng, Nikkei is all those ETF tracking passively with the index performance. So the index performance will change the constituents periodically. We so-called it something called rebalance. So you might heard about rebalance of the index. Some companies included, some companies excluded, then passive flows into particular companies increase, blah, blah, this kind of news before. So it's kind of a symbol that since last 2 or 3 years, we see the passive investment already surpass active investment in US and also in China as well. So 2 of the largest investment universe in the world. So there's a trend over there. Passive investment is overtaking like active investment right now. I think that's roughly the situation.
Yeah. So I think passive investing doesn't sound very good, right? Why do you want to be passive? People usually want to do things. Why should you do nothing? I think there are various nuances to this because we talk a lot about ETFs. Yao mentioned it many times. Gavin mentioned as well. But ETFs are not really equals to passive investing, and ETFs have evolved as well. So very quickly, passive investing, like you mentioned, it takes an index that at the beginning of ETFs, the idea is to replicate the whole market. So you buy whatever everyone else buys. So the passive investor just buys what everyone else is buying, and it tracks that index. So it's passive in the sense of relative to the market. But it has evolved. So perhaps we can talk a little bit about why would people want to go passive and why or go to use ETFs. So in this area, has passive investing, that means people really doing nothing, really overtaken active management, or is it about using instruments that are traditionally associated with passive investing, like ETFs, to form portfolios and then actively managing the allocation of this? Perhaps I could ask Clarence to maybe let us tell us a little bit about pros and cons of active investing and developments in ETFs.
Sure. Yeah, I guess I'm a bit more of a purist on this, having been in this space for more than 2 decades. I guess if you look at it, no matter whether it's active, whether it's passive, and a lot of people argue about ETF versus mutual funds, well, I think we have to bear in mind that all of this is just an investment structure. Effectively, they're all wrappers. Whether it's an ETF, whether it's a mutual fund, they are all wrappers. Active, if you talk about passive versus active, I think technically, from a implementation standpoint, we don't look at it from the standpoint of whether it's a passive or active. Because if we were to really take a step back, factor investing itself is a form of active. It's not really pure passive. But yes, I think the argument these days that what we are seeing is there's a lot more active ETFs. And that's as a result of many factors, one of which is largely asset management firms moving away or converting their mutual funds into ETFs. There's also the result of technology and regulatory advance changes that allows for the growth of active ETFs. But if you're really going to look at the size of the market, the ETF space is roughly about 16 trillion, say at the end of 2024, of which basically only 1 trillion is in active. The size is expected to grow to 30 trillion total, and of which basically active is about 4 trillion. So in terms of implementation, in terms of the size of the universe, a lot of it is still largely in the passive space. And by passive, I will largely include the factors, the fixed income segment in there as well. From a user standpoint, I guess the key is not to look at whether it's active or passive, or even within the passive space, basically to really look at the ETF in terms of what exactly you're trying to get exposure to. Right? It doesn't mean that an ETF is better. It doesn't mean that a mutual fund is better, or it doesn't mean active ETF is better than a passive ETF. It doesn't mean a mutual fund that suddenly become an active ETF today is better than anything. Just bear in mind, it's just a structure.
Yeah.
So, but from a usage standpoint, the way when we construct portfolios, right, we tend to look at basically from a risk return, a risk volatility standpoint. We use a lot of passive. We also use a lot of active, and it depends on the risk profile and a particular mandate. It can be used in a core versus satellite standpoint, where a large part of the portfolio, for example, could be passive, and then through tactical using active, or for some exposure or some particular niche thematics that you need, maybe active is perhaps a better play. So it really boils down to the different portfolios that we work with.
Yeah, so thanks, Clarence. So I think the point for everyone to take away is that the ETF is a wrapper. You know, it's like whether it's, you need to look inside. Is it chicken rice? Is it, bak kut teh? Or it is a wrapper. In the same way, a unit trust is a wrapper. And so there are certain things you need to look into. In fact, I have a copy of The Economist here. It says, ETF madness, the latest investment fad is tailor-made for gamblers. Because there have been a lot of innovative ETFs that can give you exposure to very funny things. So please look inside the wrapper. So don't just say, oh, ETF equals to you're actually not taking any specific risk. You could be actually taking risk. And also look into expense ratios, which is the cost of investment, something you can control. So we are down to about 7 minutes. Do we have questions that we can take? Be it related to alternatives or AI or any of these trends that we are talking about. I do not yet see any questions on the screens. Yeah. No? Okay, if not, then maybe we just talk a little bit more about something else related. So, I think one of the things about active versus passive investing is that managers, I always say asset managers, my colleagues from my former industry in that sense, have a very, very tough job because you always have to outperform in every quarter when people look at your returns. And I think that's one of the stresses has been that active management has it's been difficult to demonstrate in that sense that alpha. And even as we try to do better, so now we hear that we can use AI. So why can't, do you invest in AI in your portfolios, AI-related stocks? I'm sure you do, right? Because, that's part of the market. So why shouldn't retail investors just directly use moomoo AI or do their own research using AI? Why should we leave it to fund managers to deploy AI? So how is this, what are the risks and what are the sort of nuances involved in this? So perhaps I can ask Jinye, you can share.
Okay. Well, I think in UB Asset Management, we started this journey of digitalization about maybe 4 years or 4.5 years back. So what we have decided, we call it AI augmentation. So basically, the way we look at AI is like a co-pilot, but you still need the main pilot, which is the human, to drive the final investment decision. But I think as Moomoo has shown, they have deployed the AI, onto their platform. The AI can do stock research, can do technical analysis, can do stock recommendation. But I think as a human, you still need to make the final judgment. Your insights and the way you look at the world, because tomorrow Trump can come up with another policy. So these are not modeled in the AI. So it's a man and machine kind of approach that we believe it is the future of investing. If you don't use AI, AI is a tool. You are at a competitive disadvantage to a lot of investors out there, whether if you are fund manager or you are retail investor. So use AI, but use it in an augmented way with human judgment. I think that is where I think the future investing going to be.
Anyone wants to add to that?
Yeah, probably a little bit. So for AI investment, we definitely use it, but be cautious about AI we use it internally. And for research analysts, the AI kind of replacement of a search engine. So that's a question of internal data and the public data question. For example, I'll give you one particular question. A problem happened is last time when I doing the Samsung research, randomly pop up take over like news. But if you search the news source, it's coming out from a random website. There's no source or so forth. So when you fully rely on AI to analyzing all the market data or source, yeah, you open up your eyes, but unfortunately, you will including garbage out thing. So that's one thing. Another thing is using AI is for the efficiency. Probably you use the web coding by yourself. So quite a lot of process can be improved by AI programming. That's very good, but on the other side, you need to have some basic knowledge about how to link up with your database, trading system, and so forth, if you're a quant trader anyway. So if you link those two things together, yeah, there's a solution for AI investment. We are trying. Unfortunately, I haven't heard any like a pure AI-based investment strategy is very successful or be successfully launched until now, I would say, yeah.
Thank you. So I think maybe when we were sitting down there, many of the CIOs there, we had two observations, One was that, wow, Moomoo, we have 1 in 2 Singaporeans of investing age on the platform, which is great. It shows interest in investing. And then the other one was, crypto, right? So I think maybe just take the last few minutes and let's talk a little bit about what we think is the role of crypto for all of us, right? Is it something that we only let the big guys play with? Is there a percentage that we can encourage or not encourage? Of course, as investors, professional investors, we do believe that the core of your wealth building must be tied to the fundamental forces that create wealth, of economic activity and of having profits and good companies. But what about all these new things? And let's talk about crypto, because that's one thing that Moomoo has just said that they will be launching, which is, of course, very exciting, especially to young people. So maybe I'll just do a very quick round before I sum up. So maybe Wang Yi, just quickly on crypto.
Yeah, crypto is a regulated, unregulated world. Regulated, you find US is the main base. Then stablecoin discussion and so forth is based on that. Unregulated, you probably go for Binance, those guys. So from Moomoo perspective, yeah, using USDT definitely is an evolution. Yeah, I think that's my view. Yeah.
Vincent?
Crypto or Bitcoin, this is a phenomenon. It's going to stay with us. We are treating it as an alternative asset class. So our initial research suggests it has 2 elements that we have to be very aware of. One, its close cousin is gold. So it can be considered as a liquid gold. I say it's a close cousin because when you do the analysis, the correlation, the factors that's affecting Bitcoin are similar to whenever there's a loss in confidence in the dollar, whenever there's a crisis, there's a reaction, and like gold, it is a view as an asset class of safety, safe haven asset. So there's some element of that. So that's the first point. Second point is that it is new asset class, so there's not much history, so probably less than 6 years. It hasn't even gone through a market cycle or economic cycle. So the way we actually profit from it, we actually have an AI program that runs strategies on crypto. It done very well, but it does well not because it understands what it is investing. It does well because it understands the investor psychology behind it. So it tries to find out, are the price movement reflecting trend following momentum, or is it more contrarian? So a combination of these two very basic underlying investors' behavior could help, using AI, could help identify opportunities to tactically add to or take back. So it is a new asset class. A lot of things is not known. We need more time to understand the stability of this. But in the meantime, this is where AI can help.
Thank you, Vincent. Jinye?
Okay, I think crypto to me is an alternative and is relatively speculative asset. I think back to the very basic principle, you need to do your homework before you invest. So how much do you understand crypto is probably where I think you have to ask yourself before investing in crypto. Yeah.
And Clarence?
Sure, I actually agree with Junior and Vincent. I think largely, if you look at the crypto or Bitcoin, largely, if you want to, I mean, from an investor standpoint, there's a lot of options out there, right? With ETF, with all kinds of inverse leverage products out there as well. But bearing in mind that the history of the product is actually short, so that the actual path of returns or predictability is actually quite low with regards to returns profile. So once again, buyers beware. The volatility is there. So I guess for traders and out there, there's something for them. But from an investment standpoint, just beware.
Great. So everyone, I think what we're hearing is that let's understand what we are doing. When we are investing for the long term. We need to stay invested to reap what capital markets have in store for us in terms of rewarding us for patience and rewarding us for knowing our stuff, right? And where you are tempted because it is new and you want to try, go ahead and try. But please, we don't need 40% of gold, we don't need 40% of crypto, and we definitely don't need you putting 100% of your wealth, your nest egg in your retirement into these bets. Just a little bit, what you can lose and nothing more. Okay, so that's, I think, what we have to share with you today. Keep on your journey of learning about investing and financial literacy. You're on the right track just by being here. Okay, thank you very much, gentlemen. Thank you.